Tariffs, truces, and Canada's edge. If you stepped away this summer, you may have missed a few significant shifts in the Canada-US trade story. Tariff negotiations continue to dominate. US courts clipped presidential powers, and global partners capitulated in order to safeguard access to American markets. I'm Ben Fawcett, Vice President and Portfolio Manager at Canaccord Genuity Wealth Management. In this episode of Connecting the Dots, I'll walk through the summer's key developments and explain why Canada may quietly hold a structural edge. First, let's start with what changed in Canada. There's still no deal, so that didn't change. Ottawa paused its proposed 3% digital service tax to appease the US. Meanwhile, the softwood lumber fight flared up once again. US tariffs now exceed 35%, and Canada has appealed the case. Canada's own retaliatory tariffs on $30 billion of US goods were mostly lifted by September. While some tariffs remain on auto, steel, and aluminum, most Canadian exports continue to enter the US duty-free, which is an enduring advantage, while other nations face a new 15% tariff baseline under revised US terms. Next, US courts have challenged Trump's ability to impose some tariffs. In August, a US federal appeals court ruled that using emergency powers to impose sweeping tariffs likely overstepped presidential authority. The ruling, now headed towards the Supreme Court, signals that broad, unilateral tariffs are harder to sustain, even if trade uncertainty is not going away. Third, the first joint review of the US-Mexico-Canada trade agreement is scheduled for July 2026. With negotiations already underway. What's our base case? Continuation, with targeted adjustments, not a collapse of the deal. Let's remember that Canada remains a vital trading partner for dozens of US states. With a divided Congress and the 2026 November elections looming, bipartisan pressure will likely favor continuity over confrontation. And fourth, Canada is also making incremental progress domestically. Provinces are reducing internal trade barriers, Ottawa is investing in infrastructure, and both provincial and federal tax relief is starting to show up. These steps improve productivity and efficiency, strengthening the long-term outlook for Canadian companies. So let's connect the dots for investors. Trade headlines can feel distant, but they have real investment implications. When US courts limit tariff power, it reduces the risk of sudden shocks that rattle markets. More predictable policy supports stability, especially for exporters. When other countries face higher tariffs, Canada's duty-free access under USMCA becomes a clear advantage, translating into more competitive exports and stronger earnings potential. When Ottawa invests in infrastructure and lowers internal barriers, it boosts productivity and the economy's long-term strength. And when resource prices rise during global uncertainty, such as gold, Canada's resource-heavy market provides a natural buffer for portfolios. Markets are already reflecting this resilience. The TSX is climbing alongside global equities, underscoring investor confidence in Canada's position, not just as a trade partner, but as a market with room to grow. Even in a world of trade tensions and shifting policies, Canada continues to stand apart. Duty-free access under USMCA, steady reforms at home, and a resource-rich market give the country a foundation of stability and opportunity. The bottom line, Canada has room to run, and for investors, that's not only reassuring, it continues to be rewarding.